FEGLI is extremely beneficial for most federal employees, but unfortunately many pay hundreds if not thousands of dollars extra in a common trap with FEGLI-B. In this episode, we're going to provide valuable insight into your federal employees' group life insurance and hopefully find ways that you can better protect your family and save a little bit more of your paycheck. Welcome, I'm Ed Smith from Valor Wealth Partners, where we're dedicated on educating federal employees on how to maximize value from their complex and often underutilized benefits. In this episode, we're going to be talking about the federal employees group life insurance, more specifically looking at FEGLI-B and how many people are overpaying for this benefit. Life insurance is a complex subject. And let's be honest, life insurance salespeople have a reputation sort of like selling used cars. It's not a good one. But there are valuable resources and reputable people you can go to help you find the right answers. In this episode, we're going to look at some of those resources that you can be able to use, look at what you need to do to evaluate the correct amount of insurance that you need. We're also going to look at the pros and cons of FEGLI. And finally, we're going to provide you options to explore so you can better protect your family and hopefully save you a little money. As always, we have an ebook that we create with this valuable information that is just filled with information. And if you like this content, please share it with your friends, subscribe to the button, and ring that bell so you are notified when we have new episodes that come up. Not all advice is equal, and this is especially evident when you're looking at insurance. If you are getting advice from somebody and they're also earning a commission when they're giving that advice, there are significant conflicts of interest that you have to address. This would be similar that if you went to a doctor's office and they earned money on the prescriptions that they made or recommendation to you after your exam. Most advisors that give advice to federal employees earn commissions from selling insurance. Now, this isn't to say that they're bad. I know a lot of them, and they're really nice people, and they're ethical, and they do what's best for you. But the conflict still arises. And if you have a choice, which you do, what would you prefer? Unbiased advice, a conflict-free relationship, and the comfort that the recommendations only benefit you. If you decide to work with an insurance agent, please make sure they are completely independent. My knowledge and my perspective comes from over 20 years of working with clients and designing cases for them. My second job in this industry, I worked for a major insurance company. I was a captive agent. And when we would make recommendations on insurance, we were required to use the company product as at least one of the solutions that we proposed to the clients. And if I came back and wrote a policy that wasn't the company's products, I was explaining that to my sales manager of why I chose a different product than the company's product. And it was truly made clear that I was working for the company and not for the client. Now, I never let my ethics and my morals be deteriorated by this situation, but it was something that always stuck with me and made sure that we always do what's best. To me, this is not a fiduciary standard under any circumstance, and you really want to be able to make sure that the advice that you're getting is independent. Now, I'm very much glad that I'm no longer a captive agent. In the years that I've been in this business, most of the time I was not in that type of situation. But I've made a clear decision to never sell insurance again or to work under that type of model. And the reason is because I want to be conflict-free and work on the client's best interest. Our goal is not to sell you insurance in this episode. It is truly to educate you on what is best for you and your family and hopefully save you some money. The first step before buying any insurance or evaluating what insurance that you have in your portfolio is to first identify your needs. You need to know what you truly need before you start looking at the tools or the resources of the insurance products. Now, you might not need insurance at all, and for younger employees, this might be the situation. Remember that insurance is there to replace a financial loss, and this isn't just life insurance, it's any type of insurance. So first, you have to make sure that you're protecting something. All families are different, and you have to make sure that you're addressing what your unique needs are. One of the things that you want to be looking at is the income that a person is generating. And this, to me, is one of the biggest levels that you have to look at of how much of insurance you have. There's a rule out there that a lot of people use that's 10 times your income. Now, this could be good if you have young children, but it doesn't apply for everybody. So again, take this into consideration that the income replacement is bigger than a lot of the other factors. Sometimes people look at debt or other obligation as the reason for insurance, but without your income, your family would be having a lot of things that they wouldn't be able to do. So going beyond income, we want to look at some of those other things. And debt might be one of them that you want to protect against debt. Another factor might be some big goals that you have. Maybe you want to make sure your children have the college education that you want, or protecting your spouse for future income into retirement. And this could be looking at that survivor benefit plan and figuring out what is best. Is it best to get the survivor benefit plan or more insurance, either through FEGLI or through an outside private insurance? Another factor could be estate taxes. Some people will have massive amounts of estate tax, and life insurance could be a very good tool for that. There are a lot of uses for life insurance, and you really want to be able to evaluate what your needs are before you start digging in and start buying something, or just re-upping on different types of policies that you could possibly have with your FEGLI. So please take this step very seriously and do analyze your survivor benefit plan with this whole process. Now that you know what you need, let's start looking at what the resources you have. And the first place you should look is your FEGLI insurance. But you need to understand what your FEGLI is. So let's look at some of the pros and cons of your FEGLI. And I'm not specifically talking about FEGLI-B, I'm talking about all of your FEGLI. The basic level that you have does not have any age requirement, meaning no matter how old you are, you pay the same price. All of the others, unfortunately, do have an age component. So your FEGLI-A, B, and C, the premiums increase based off of the age that you are. And they normally go up every 5 years, but one of them does go up every 10 years. So it is something you have to look at. But beyond age, they all have one real good benefit, that the premiums do not increase based off of health or pre-existing conditions. They don't increase if you're a smoker, or if you have other lifestyle choices that may be very active, like skydiving or something else, that in private insurance they might go up. On the other side, though, they don't go down because of a healthy lifestyle or because of things that you do or being very safe. So while it doesn't increase it, it also doesn't decrease it, and you might be able to find something that does have those different variables if you're looking and shopping around. Another good benefit to be looking at is the extra benefit for younger employees, and most people forget about this benefit. But if you're younger, take a look at what this means in your FEGLI package, because you could actually have more insurance than you think you have. You also have to look that the insurance is only there while you're employed, and at some point you will not be a government employee. You still might have needs, and if you have to go out to the private sector to get the insurance, you might not qualify. So it might be something that you look at earlier, because your insurance needs and the insurance coverage you have is based off of your employment. And this is very critical that some people don't even think about. The last part I want to talk about when we're looking at what you have for this great benefit of FEGLI is actually your choices and breaking them down in both while you're working and then also what your choices are in retirement. So let's look at them while you're still working. So your basic coverage is your salary, rounded up to the nearest $1,000, and then added $2,000 to this. FEGLI-A is a flat $10,000. FEGLI-B is your salary rounded to the nearest $1,000, and then a multiplier of 1 to 5 of whatever you choose. And finally, FEGLI-C is for your spouse or your children, and again a multiplier from 1 to 5. Once you get to retirement, you have a couple of different choices. For your basic insurance, you can keep either 100%, 50%, or 25% of the coverage that you have in place. We'll go in depth into this in a different video, but that's the options that you have. For your FEGLI-A, it's an automatic reduction to 25% of your coverage. And for both FEGLI-B and FEGLI-C, it is either you keep 100% of it or you have none of it. So those are pretty much where FEGLI is. I think it's a great program, and you definitely want to understand what the benefits that you have and how it plays into your life, because this should be the first level that you get for insurances before you look outside to any private insurances. What are the FEGLI-B traps? And the whole reason I created this episode? Well, let's start off with relying on the group insurance for your only insurance. If you develop health conditions in the future and you leave employment, you might not be able to get insurance. and this could be very dangerous for you and your family. So please look to the future and make sure that if you might have a reason to leave federal service, that you have the coverage that you need even if you're not an employee. The next big thing is how you pay for the premiums. It's really easy to take it out of your paycheck, and so easy that you don't even realize that the premium increases every 5 years. Most people don't even see this change happening, going from one paycheck to the next paycheck on your birthday. But I can tell you, these increases are significant. You want to be aware of what's going on. Now, we took information right off of the OPM website to make sure that you have the best information. So let's share that information with you. There are 10 potential increases to your FEGLI-B as a federal employee between the ages of 35 and 80. And through those 10 increases, only 3 of them are under 50%. And one of those is at 47, so it's pretty much 50% as it is. On the other side of the equation, you have increases up to 120% from one paycheck to the next paycheck, and that's at age 60. Take a quick second and look at all of the increases that come up through the different periods of times when you hit a specific age. Now look at what your next increase is going to be. How bad is that increase going to be? And a jump and that is taking out of your paycheck in that very quick period of time. Then look at the next jump and see what that number is going to be. This is going to be a significant increase and a huge change to what you're already paying for the same insurance. While seeing a percentage of an increase is impactful, we really want to be able to look at what a dollar amount of a premium change would be. So we're going to use the example of a $500,000 of FEGLI-B to see how much that would affect you. At age 34, you'd have a $22 per month cost, which isn't that bad. It's actually a pretty good price for that number. But when you have the changes, you're going to have an increase at age 60 to $477 per month. That's over 2,000% in that period of time. Now, I know it's a significant period of time, but that increase is just too much. And $477 per month really eats away at what you will be getting and what you need. Now, when you look at going out to age 80, if you keep this FEGLI in place, that's $2,860. That's a significant amount. That's over $34,000 a year. And also, what that means is that you are going to have to take that out of your pension. It might be all of your pension. Now that you've gotten a good education on what FEGLI-B is, and also how the premium increases could affect you, let's look at what some of the other options you might have are. Going out to private insurance, there's a couple of different types. The first is term insurance. Now this is very simply, you start at one point and it's for a term or a set period of years. This is generally the lowest cost that you're going to find for insurance and is really good when your needs will decrease over time. Another type is permanent insurance. Now permanent insurance is there to provide you a lifetime of insurance. So it's supposed to be there for as long as you live and not just that set period of time. Now, not all insurances that are permanent are guaranteed to be there for the rest of your life. You really have to understand what the differences are. Generally, you will pay a higher premium for a permanent insurance because what you're doing is setting aside of money earlier in your policy for later on when your insurance gets more expensive as you get older. The 3 basic types are whole life, variable life, and universal life. And you want to dig in to figure out what exactly they are. The third option is a hybrid type of a policy. Now, in a hybrid type of policy, they might be combining life insurance with another type of insurance, like maybe long-term care or an annuity or even a disability type of policy. These can be beneficial if you have multiple needs and the price is beneficial. But you also have to make sure that you will need both of these types of coverage over the duration of the time of the policy. Now let's see how the term policies and the permanent policies will compare to the FEGLI-B, going back and using that same chart that we used earlier. For an example, we're going to use a 30-year term policy. Now I don't know your unique situation, so I don't know what's appropriate for you. But a 30-year term allows us to see a little bit of time on this chart that we used previously that showed the increases over the time of being a federal employee. As you can see from this chart, the 30-year term starts as a little bit more expensive if you buy it, say, at 34. But over time, because it's a flat amount for a set period of time, it is a lower cost per month over that period of time. And again, remember, the term policies start at one point and go for that duration. In this point, it's just 30 years. But there's a wide variety of different policies that you can have. The other thing you have to be able to look at is that the price is changing based off of different things, like health, smoking, and your lifestyle. The same would apply for a universal policy. Now, a universal policy, you would get it at a specific age, and it would be guaranteed to be there for the rest of your life. Now, not all policies are the same, but almost every universal life policy is guaranteed to be there for the rest of your life, no matter how long you live. The other types of policies, the whole life and the variable life on the permanent side, may not have these same guarantees, but could have a bigger cash value bucket for you. Again, these policies are more expensive earlier because they're going to extend that out over a longer period of time. So these are really good if you want to be able to have them. In addition to having just one of these policies, you could be looking at a combination. Unique case design can be created to be whatever you want. Now in the red, we've shown you a 20-year term, which is obviously a little bit cheaper than the 30 because you don't have that extra 10 years of life expectancy. And because we have the 20-year term, we can actually reduce our costs on that universal life. So between the two of them, you might pay a little bit more earlier on, but then you don't have to have it long term. Maybe you have kids that are going to be going to college and they're not going to need the coverage as long as you live, but you want to be covered while they're younger. And so you can decrease the term if you want. Now you also can look at policies that have a 20, a 30, and a universal life. You can be as creative as you want depending on what your needs are. Hopefully today was very educational and opened your eyes to what you need to be looking at when you're looking at insurance, what your FEGLI is, and also some of the traps that you might fall into with FEGLI-B. In summary, I just want to remind you of a couple of quick points. That the easy road isn't always the cheapest or the best for your family. And while FEGLI might be the best insurance for you, you want to be able to make sure and truly that it is. And finally, when you're looking at buying insurance on a private side, make sure you're getting unbiased and conflict-free advice. Thank you for your time today, and I look forward to the next episode where we hopefully can share more information with you. Thank you.